Brendan Allen, ultimately owner of Allen and Co. Tax and Accountants and owner of Landlord Tax Returns.ie. You're very welcome to the podcast. How are you today?
I am first class. Thank you, Paddy, for that. Yeah, I'm a chartered accountant, chartered tax advisor, and love to talk about tax. It's sort of a real passion at this stage. And I've concentrated the last 20 plus years just on property related taxes. So, I've developed this niche market
Sure.
rather than general accounting, which I did for many years and was had my own practice for many years. So it's just tax orientation now for, as I said, property related taxes.
Excellent.
And I enjoy talking about tax because there's so many tiny little intricacies there that landlords, some of them are not aware. There's been massive confusion over, for example, this new landlord tax credit, which was introduced for 24. And basically, the minister actually met him as part of a delegation, and he was saying, "Oh, this famous 600 credit for tax year 24 will be available against all properties," but that's actually misleading because it's only associated with the person and not with the number of properties you have. So if you have 20 properties, you still only get your 600, and it is confusing in the way the legislation is set out. And I think the minister was a bit devious in the way that he was talking about it. But look, I'm not a political person, but it is what it is.
I did see your post from last year, right, when you met with the minister with Mary Conway, who was a former guest on the podcast as well from I think the Irish Property Owners Association.
Yes, yeah.
What did you come away from that afternoon or morning thinking or feeling about their?
Yeah, well, the minister, he gave us a very warm welcome, and we entered into his office, and it was very pleasant. Yes, we'll keep in touch, and we haven't had an email back since. That's 2 years ago. Now he's no longer the minister there. However, we did point out to him the sort of landlords that are stuck. And what I mean by that is you've got landlords who cannot raise their rental income, yet their outgoings have increased, particularly if they're heavily borrowed with the increase in interest rates. So what you've ended up with is a number of landlords who are in this particular bind. They've more outgoing than incoming. And now if you go on to the calculator that our colleagues in the RTB have, it's not possible to increase your rent. I mean, it is so unfair. Now, I know this morning the DAFT report has been published, and it has recognized the damage that this rent pressure zone regime is doing, and they've recommended a number of things. And I heard Ronan Lyons this morning say on the radio that, look, once the tenancy is ended, you should be able to increase your rent to market rent. There is also talk about this reference rents, and really the calculation of trying to get that right is going to be so difficult. I don't think it's going to be a runner. I think there was some merit initially in bringing rent pressure zones in, but that is long past. And I think landlords are now stuck. And when we hear rents have gone up by 20% and they've done whatever, but that's only new properties. It's not ongoing tenancies.
Okay. Yeah.
And bear in mind, private landlords, we generate 5 times more property than the institutional landlords, who effectively don't pay tax because of the way that they're structured. So it's an unfair marketplace. And now this concept that was put across last week, we've got to give investors more incentives. Yes, fine. But you also need to look at landlords, the private landlord sector. For example, look at capital gains tax relief, keeping your property, that you will get a relief from capital gains tax. There is already a precedent for that there was a scheme a number of years ago that was quite successful and did keep properties in the marketplace. Landlords are running away from the private landlords from the marketplace because of the damage being done by the rent pressure zones, and so are institutional investors. If you don't know what your income is, and if you can't forecast what your potential income is, why would you bother invest? I mean, landlords are part of the solution to the housing crisis. We're not the cause of it. And, that needs to be recognised at government level. You can see I'm biased. I see you smile back at me. But that is the case, I believe,
And so there's a couple of things in there that I'd like to get your view and input on. So one is, I suppose, as landlordtaxreturns.ie, you look after private landlords, and you're
Correct,
a private landlord yourself by what you're saying, right?
Yeah,
So what are you seeing in the marketplace amongst private landlords? Are they actively exiting, or are they waiting to see what's going to come through here, or are there is it net increase or net decrease over the last 12 months, say?
It's certainly a net decrease, because landlords have got to get it. I mean, if you're faced with a situation where you're, even before you take in your other expenses, your mortgage interest rate is more than your rent. I mean, you're in a very damaging situation, and you could end up, as happened to a number of landlords, where you've got to sell your property. You can't sell a property with a sitting tenant. Who would want to buy a property where your income is limited and there's no prospect of it being increased? And that's one of the principal reasons why landlords are leaving. The regulation around landlords is quite high. I mean, tax is a key factor, but it's not the only one. If you're limited in looking at your set of circumstances as a landlord, you need to get out if you're heading towards bankruptcy. And quite a number of landlords have ended up in that way. And also, it encourages people to some tenants, and certainly landlords, to misbehave. And you end up with a situation that once a tenant has been in your property for 6 months, they have an indefinite tenancy. Now, obviously, there are notice periods where you can say, well, I'm going to I want to move into the house myself, or I'm going to do substantial improvements on the property. But in each of those cases, you need to sign a statutory declaration to say that you're going to sell it. And if it doesn't sell, the tenant has the right to move back in. Or if you're doing substantial renovations, you need to prove what they are by having a certificate from an architect. So while we want fairness in the market, it is screwed very badly against landlords, in my personal opinion. It's not. It's an unreasonable market where somebody has total power and the other is in a limited situation.
And I think it's interesting. I'm sure there's a fair percentage of the population who'd say all the power is in the landlord's hands, right? They're the big bad owners, right? And here we are paying, more than we would be paying if we had a mortgage to rent this place and pay that landlord's income / clear their mortgage for them, right? So that's the other side.
Absolutely.
Which I 100% empathize with as well.
Yeah. But yeah, it's a two-sided situation. Look, what a lot of people have done have become accidental landlords or have bought a second property or whatever to look towards their future as part of their tax planning or income planning. And yes, I do clearly understand, look, nobody wants to be homeless. Landlords do not want to make people homeless. That's not the idea. The idea is to provide a quality home for somebody. But is it a quality home that has been maintained by a landlord or not? For example, if you've got a long-term tenant, you as a landlord are still responsible for the maintenance. So if you've got somebody in your property for 10 years, you still have got to make sure it's properly painted inside and out. You've also got to make sure all of the necessary requirements of the building regulations are met, and the regulations under the OTB.
Yeah, no, there's certainly commitments, and it's interesting. Like we see property prices continue to go up, right? So I think
Yeah,
it's interesting as an investor, if
yeah,
your investment choice happens to contain a residential property that is being rented out, you're generating income. Yet, granted, there might be limits on the increase to that income over time based on the rent
yeah,
pressure zones, but the
yeah.
capital value of the asset certainly has been appreciating quite favorably in recent years. Is that fair?
Yeah, certainly in many cases that is the case. But bear in mind, if you're a landlord, you're selling your property, right? You're faced with capital gains tax of 33%, and that's quite a whack of money if you've invested in that. Now, there are obviously ways that you could look at that, and if it was possible to get the Goldilocks solution, is what I would call it, if you can operate your rental business through a pension scheme. That, in my opinion, if you're smart enough and young enough to do that, that is the right answer for a landlord.
Okay.
Now, it must be totally at arm's length.
Yes.
No capital gains tax, no income tax. Then you can take your money out. Oops, there's my phone going. You can take your money out when you get to the age of retirement. And just what we touched on pensions there. What's interesting now is the PRSA changes that came about. And as an advocate of pensions, I don't advise on pensions. I'm a tax man, okay? I like the PRSA contributions. Now, they're only available to employers' contributions.
You're talking about the 100% of salary contribution?
That's correct, yeah. So if you're in a limited company, and it's one of the attractions for being in a limited company, and that is this, the employer can set up PRSA pension, they will get tax deduction against that.
In the business.
Against his rental income, as well as if an ordinary business. So that's quite an attractive option.
Okay.
And I like that. And if you're clever, somebody like yourself, Paddy, where you could get a number of PRSAs put in place for yourself, with different dates on them. And the idea then is, if you only, for example, crystallize one of them, the remaining ones, right? If you get your call to God, your spouse can get those contributions back free of tax. So it's quite an attractive option. That only came in since January of 23. And it was changed because, again, some landlords abused that option by putting in multiples of salary. So in the last budget, the minister said, well, look, your PRSA contributions cannot exceed 100% of your salary. Just bear in mind, just to clarify, this is only available in limited companies. It's not available if you're in a partnership or a sole trader, and if the company must pay the contribution, not you as an individual.
Absolutely. So company ownership of property is one I'd love to pick your brains on as well.
Yeah.
Another thing that's, just before we do, another thing that is has been getting a lot of media coverage over the recent week was the potential change to the planning permission requirements to put a modular home garden room in your back garden, right? The intent, depending on what you read, the intent is to perhaps allow parents to downsize out to the garden and maybe free up the home. I'm not exactly sure. What do you think is going on, and what do you think the intent is with regards to the tax piece and the rent a room potential here?
Yeah. Well, if you add on a Shomra style operation in your back garden, that would not qualify for rent a room. Rent a room, it must be your principal private residence, and it must be part of the fabric of your house. So you must enter through the normal entrance. It can't be
building.
It can't be a building project outside of it. And I think to watch, I mean, if you're disposing of part of your back garden, okay, what are you doing? You're generating potential capital gains tax liability, for example. Because what can happen is this: the piece that you're building, this shoma or this thing out the back garden, and if you're either going to sell it or if you're passing it to your children, it will be, by the Revenue Valuation Office, put up at market rate, and that you lose part of your principal private residence.
But only if you transfer the ownership of that.
Only, yeah, exactly. Only if you
that road.
transfer the ownership, that it will happen. But again, you've got to think is this: what are you doing? Even if you don't transfer the ownership, you're effectively giving a gift to your children of a right to residence in a property that you own. And there is a tax consequence of that.
Would that be considered the outcome?
Well, it could be, depending on how it's structured. But typically, what you're doing is you're providing accommodation free of charge for your child. Okay? And that, if you like, is a potential gift, or it could be deemed to be rental income, depending on which tax inspector that you're dealing with. So it is something to watch. You know?
Interesting. If they do change that permission, right? So let's say the scenario where you can put a residence in the back garden without planning permission. I did read somewhere there needs to be 25 square meters. Nothing has changed officially yet, but there still need to be a reasonable sized garden remaining.
Absolutely, yeah.
The question was, well, would they potentially, if they do this change, would they potentially also extend the rent-to-room relief to this new?
Yeah, I wouldn't think so. Okay. And the reason why is because there have been so many challenges to this rental-room scheme over the years, and the revenue have insisted on it being part of the fabric of the house, is the wording that they use. So it's got to be, the one entrance, part of the overall house. I mean, I've got a client who actually uses this rental room, but he also uses this ARP, the accommodation recognition payment, right, which is the 800 a week for a Ukrainian tenant. And so he's got his 14,000 is tax-free. He's got his 800 tax-free. So 24 grand plus whatever that would, when you gross that up. Now, there's a lot of inconvenience in it, but I wouldn't do it myself. But look, what they're going to do with the government have the power to do as they wish to try and relieve the crisis. They've had the Housing Commission's report, they've had the draft report, and there's this part of the IPOA and other interested parties have made submissions. But it's now up to the government to act. I mean, the rent pressure zones, which we talked about earlier on, were introduced as a temporary measure many years ago, and they have failed to solve the problem. They've made it worse. They've created more homelessness. The rent pressure zones.
Okay. On the rent-to-room relief, I did hear an interesting one. It was, I think it was part tongue in cheek, Brennan, to be honest with you, but it was along the lines of, well, okay, if they do change this, right, and you're allowed to, without planning permission, put a building in your back garden, if they're not going to change the rent-to-room relief, okay, so that rent-to-room relief will only apply to if there's a room in the fabric of your home. Well, then move your bloody kids out to the back garden and rent their rooms out, and then you qualify for the rent-to-room relief. I thought that was interesting.
It certainly would be. And I'm always amazed at the ingenuity of some taxpayer to either exploit the rules or bend them to their own advantage. And look, you don't have to have your affairs set up in such a manner to make it easy for the revenue to pluck the feathers out of your golden goose, if it is such a thing. Or is it a turkey which is damaging you? So it depends. The art of taxation is to pluck the goose with the least amount of squabbling and noise, isn't it? So
how much of tax planning in regards to landlord tax returns is art and how much is science? Like, is it black and white, or is there areas where people can nuance?
Yeah, like to a degree, there's interpretation, and then there's the reality. In my opinion, tax planning is available for you. in a number of taxes, but you've got to be very cautious and mindful of what exactly are you doing. Are you trying to build wealth, or are you trying to generate an income? Now, my take on that is, if you are trying to generate income, hold them in your own name. That's the easy way, right? And that's straightforward. There's a low burden there where you're not, it's quite easy to set up. You don't get caught up in some of the intricacies of being involved with a limited company.
Okay.
So with a limited company, there's a high burden of administration. You've got to engage with accountants and tax advisors and so forth. And there is issues around disclosure and so forth. But again, I'll come to that. But if you set up a limited company, own the property in a limited company, you're looking at a 25% tax rate as opposed to a 52%.
Yeah.
Now, it's not as straightforward as that, because
on income now, right? Yes.
On taxable income.
Yeah.
Okay. And interestingly, the way your taxable income is, they use the same process, be it in a limited company or as a sole trader. There's some slight nuances with regard to some of the expenses, which we can touch on. But the idea then is you're looking at 25%.
That's to the company. It's still in the
company itself. So it's the company's tax liability. Okay. Yeah. So the issue then is, if you've got your 25%, and let's say you made a profit of 100 euros, 25% of it is gone. Okay. So you're left with 75. So that's 75. If it's still there within 18 months, in the sense that you have distributed dividends, there's a further 20% close company surcharge that applies. So it brings up the effective rate to 40%. Now, ways around that: pension contributions, as we touched on earlier on. And I must acknowledge the change in the legislation brought out by the previous Minister for Finance. I think it's a good idea. Now, so you've now got, if you can reduce your taxable income inside in your limited company by the PRSA pension contributions, then you're faced with a possible surcharge. Now, if your company is resident in Ireland, it's certainly liable. However, if your company is resident outside of Ireland, the close company surcharge doesn't apply. But then you've got overseas compliance, and it's not a way I would go. The latest figures I had from Revenue was there's only approximately 100 limited companies that are non-resident landlords. It may have gone up in the last 2 years. But so what often people would do is this: they would set up what's called a holding company. The holding company then would own the shares in your rental company. You would dividend up your profits prior to the financial year end. And to use Father Ted, it's the money is resting up in your holding company, but you mitigate that 20% surcharge. And often then that money, what is done is it is put forward for other adventures or other trades that you may be involved in. But the key thing is this: if you have your holding company, why not consider some inheritance tax planning? You give shares to your children. Now, once they're a human, they can have shares no matter what age they are. But effectively, it's called a bear trust, which is you're holding them on behalf of the kids. So they don't need to be 18. They can be. But the idea then is this: once you get the value of those shares into the children's name, okay, as the portfolio grows, there's no additional inheritance tax payable. That's a nice tax planning approach, I think. However, you need to be very careful with the type of shares, because I found with our own kids, when they got to about 14, They realized parents had no bloody brains left. And it took them till they were about 25 before they realized there was something in between their ears. So the idea is that you look at A shares and B shares and just make sure you don't lose control. Now, look, family partnerships is another way of going through companies. I mean, the better in the sense there is a situation where there is limited liability. It's also if you're selling your portfolio, selling the shares in the company. Yes. I've got a particular client, he's got property in the past where you live, let's put it that way, and he's selling it for £2 million. But if he was to sell the property, or if the company was to sell the property, 33% would apply.
Yeah.
Then another layer of tax when he takes it out. So he is taking advice. He's selling the shares, and he's got a vendor willing to buy the shares for £2 million, and so there's only one layer of capital gains tax applying on his ownership of the shares. So it's a good. Well, I think it's a good approach, and it's quite popular.
Something I see a lot is people might have one or two or whatever number of properties, and at some point, once they recognize their own mortality or whatever the case may be, or the kids become of an age where they're adult and responsible, and whatever it is, the question can often pop up. We have these properties that really we probably don't need to continue owning ourselves, and we'd like to pass them on to the kids.
Yep.
Fairly common scenario I see. From a tax planning perspective, are there, and this is where they're held personally, are there obvious things that people could consider?
Yep.
One or two properties or what?
Indeed, and you need to be careful with this in the sense that there is a tax planning opportunity, and that's the following. If you live in the house for 3 years, say prior to it being passed to you on death, and it is your principal private residence, there will not be a tax liability. However, that can be challenged if you've got an interest in any other property at the date of death. So very often I've seen situations where, say, the daughter is going to inherit the family home and they're living with mum and dad, but she's also got another house with her husband or with another partner. I mean, obviously, you need to pass that across to the other partner involved, because if you hold that property at the date of death, you've got a problem, because you will be fully liable.
Yes.
But also bear in mind, the other issue is there is a threshold, a CAT, that's capital acquisitions threshold of 400,000. Now, the 400,000, basically, it's from parents. It's not 400,000 by 2. It's 400,000 from parents. So if the value of the gift is 400,000 or below, no tax. If it's in excess of that, and that's where getting the valuation of what you're getting is important, to make sure that you can stand over the valuation and that it does make sense. So you want to get at least 2 local valuers, to make sure the valuation that you're getting is the correct one.
Okay.
And then obviously, if you do pass something on during your inter vivos in your life, there's an issue for the person giving the property to their child, assuming it's child. Because if you think about what's happening is you're disposing of an asset.
Yes.
Okay. Now, if it's not your family home, but if it's a rental one, what is happening is this. You're disposing of your asset, therefore it is subject to capital gains tax. And also, your child, if the valuation is greater than the threshold, is liable to capital acquisitions tax. Yeah. However, there is a relief available whereby the if they're done at the same time, the capital gains tax is paid. There is an offset against the CAT, and it generally works out roughly the same in my experience. But the capital gains tax must be paid first, and then CAT levied. Now, so you need to watch that. Or even if you're inheriting a property, for example, on the death of a parent, and you hold on to it for some considerable time, and not your principal private residence, think what happens. There's been a capital gain since you acquired it. You know, so you need to watch that. In fact, with an interesting case a number of years ago, where a client had inherited a pub. Now, the valuation at the date of death was 4 million. However, because of the decline in the valuation of pubs, on the valuation date, which was sometime later, because the valuation date for CAT is the date where you actually acquire the full beneficial ownership, but it was 2 million.
Wow.
So he had a substantial stake if he was going to be paying 4 million as opposed to the actual valuation date. Now, we had to prove the valuation of 2 million was right. And again, well-recognized valuers is the way to go with that. But it was an interesting case just to be.
And just out of curiosity, so sir, his CAT, his or her CAT liability was due when the full ownership
passed to him. Yes,
there's the 2 million. So they didn't pay it on the 4 million, and then
exactly
at the 2, right?
Exactly, yeah. Okay. But again, it's you want to watch the valuation date, and that's the key date for that sort of thing. One of the other, by the way, just small nuances about capital gains tax. If you dispose of a property in the particular tax year, you must pay your tax immediately, okay? And the issue then is you pay it, and there's a little payment slip, thank you, revenue for that, but you file the tax return a year later. I find clients get confused by that. Okay. But the trick is pay the capital gains tax when it's due. And just while we're talking about payment dates, I am flabbergasted. We've got dates for income tax, different dates for capital gains tax, different dates for CAT, and this new vacant property tax, a different date again. I mean, look, I work in tax every single day, but if you're not familiar with the tax rules, how in the name of God can you keep up with this? And even I get confused. I've got to reference each time depending on the tax that we're looking at. Of course. So it's a confusing system. However, it is what it is.
It is very confusing, and that is for sure. In terms of that piece around tax efficiently passing on property, so that dwelling house relief, as you said, if the son or daughter or whoever is living in the property for the 3 years prior to death and then remains in it for a period, then it can basically tax-free pass to that individual. But in the case where it's not the principal private residence, not the family home, it's an investment property or two. Again, is there an obvious mechanism to pass the ownership, or is it generally not advisable? Just let it run until death and sell the frigging thing if that's what they just choose to do.
If it's an investment property, I wouldn't pass it during lifetime, because what you're doing then, if it's an investment property, you're just generating a CBT liability. Why do that? Now, there is, as you're probably aware, I think it's called Section 72 policies now, whereby, you can buy insurance cover, but you need to crunch your figures on that, because it can be very costly if you take it out at the wrong time.
If you live too long, yes, absolutely.
If you live too long.
Cost your fortune, you'd be bloody kicking yourself. What the?
Yeah. But again, look, it's one of the approaches that are available to you, and no doubt you've sold some of those policies yourself in the past.
Don't do them, but we looked at them for people, and again, crunching the numbers, quite often people are like, look, I don't want to I don't want to bet on my own demise here. Is quite
Yeah, exactly.
right. Whatever the numbers might say, psychologically, I'm not doing that.
Yeah,
Um,
yeah. I'm just amazed by talking about death that people get worried about making a will.
mm,
I'm always amazed that the reluctance in some people's mind to make a will. It all it does is tidy up your affairs,
mm,
and it makes it easier for your children or your spouse or whoever you're leaving your property to. For God's sake, it doesn't mean you're signing off your lifetime. All it does is you are being a responsible person in dealing with your affairs. The other thing that you should do is this: do an enduring power of attorney as well. And that, in many people, is called a living will. It just, if you become of unsound mind during your lifetime, it covers off that. Now, there's been some complications with that in recent months. The Law Society weren't happy with some of the new arrangements, but I believe an agreed peace deal has been signed off on that for the minute. And
which is I think great recommendation. Something I encourage everybody that I speak to do.
yeah,
Again, it's something you hope won't need to be relied on, and if so, it won't be for a very, very long period of time. But when
yeah,
things go wrong and it's not there, it can be an absolute
yeah.
mess.
But a total mess. But the enduring power of attorney. If, for example, I had a client who had a hotel in the west of Ireland, and there wasn't an enduring power of attorney in place. So we had situations where because the bank account, like the big man, was in his own name, the only signatory, the
Yeah,
whole business collapsed
yeah,
because the wife couldn't get access to even pay the basic bills.
yeah.
You know, it was shameful, really.
Desperate, and I see it as well, and where perhaps there might be one large pension that's going to provide income for a household, for argument's sake, and pensions have to be in one person's name only. So if that person becomes incapacitated and they want to make decisions around drawdown or investment strategy or increase, decrease income,
Oh,
tough, right?
exactly.
The pension pot is still there, but you have no control over it. You can't adjust it, or right. You
Exactly.
have to run in line with pension authority rules, and again,
Yeah.
that's very, very restrictive. So having an enduring power of attorney is a no brainer.
Is a good way of dealing with that. Exactly. And
Absolutely.
you got to watch too who pays the pension, as who gets the pension relief as well for the tax deduction side of things.
Yeah, absolutely.
So
But coming back onto tax, Brendan, in
yeah,
terms of for landlords, are there some common mistakes that you see landlords making that you say, look, folks,
yeah,
this is something you need to be
yeah,
doing.
the biggest one, in my opinion, is whether you're in a company or as a sole trader, is failure to recognize capital allowances.
Okay.
What capital allowances are is, for example, if you purchase a property and there is furniture, fittings, all of those sort of things, right, inside. And it used to be the old way that you would list all those to avoid paying stamp duty on them because they fell outside
Okay.
the stamp duty, the way they were passed to you. So the trick is to list those carefully, okay?
Okay.
And put the value at the date of acquisition on them, okay? And even if you're buying new ones, put those in. So capital asset would be, for example, it's something that will endure the life of the property and not something that's an immediate repair, if you like. And people like myself live in the world of trying to decide, is it
Mm,
capital expenditure or is it a repair? If it's a repair, you get immediate satisfaction and immediate relief uh, against your rental income.
yes.
Capital allowances, it's 12.5% over 8 years.
Mm,
Look, if you do it properly, I've seen cases where you're getting up to 20, 25% of the capital purchase by properly notating and getting proper valuations. Now, if you're buying a big property, look, for God's sake, engage a capital allowance specialist. There's
Okay.
a number of them around
Really?
the country that do that. And what you can do, if it's done properly, the sanitary ware, electrical, the kitchen,
Flooring.
wardrobes, flooring, but again, you've got to have somebody who knows what they're doing.
Just guessing.
Yeah. Not guessing won't work, because if they're substantial, the revenue challenge them.
Okay.
And what you need to do is to have a professional in that. And can I mention somebody's name?
Yeah, sure.
There's a gentleman I use extensively called Philip O'Connor of CA Partners. He's a tax advisor, but also I think he's a quantity surveyor as well. So we can look behind the wall and look at all the various things that are there. And there's substantial tax savings there.
Okay.
So in addition to the capital allowances, pre-letting expenditure now is available in certain circumstances. So the property must be vacant for 6 months
to qualify for pre-letting.
Qualify for it. But again, you've up to 10,000 as a deduction, which is not so bad. The other thing is, if you're the landlord and you're doing a bit of retrofitting on the property to upgrade the BEAR rating, again, the grant is available from the SEAI. Plus, then you can claim up to 10 grand of a deduction for doing that. But bear in mind, it's going to do two things. The tenant, by paying the electricity bill, will get the benefit of it. But also, in normal times, you get a better rent for a B or a C than an E or an F property, So it's worthwhile looking at that. That pre-letting expenditure is available. There is also a thing called the vacant property grant. So if the property's been vacant, say, for 2 years, right, you can get, let me get this right, a grant of 50,000. Now, again, what you need to do is negotiate with the local authority on that, to confirm that it meets the requirements. And in certain circumstances, you can also get up to 70,000 if the property was declared to be derelict.
Okay.
And also, by the way, if you live in some of the islands around the country, around Ireland, there is higher grants available in that. And then there's another thing that is often missed too, is the Living City Initiative, right? And basically this covers Kilkenny, Waterford, Limerick, Dublin, of course. Did I mention Cork as well? Yeah. So the main cities in the country, Waterford is included as well.
Okay.
I hope I didn't offend any Waterford people if I left it out. But the idea here is this: if the property was in existence in 1915, so the idea is to regenerate the city areas. You can get tax relief again over a number of years, but you can spend, it must be a minimum of 5,000, but the total cap on its tax relief is up to 200,000. So I've got a client who operates primarily in Limerick. And what she has told me, she said, this is like getting a loan from the revenue. Now, there are conditions, right? It's not a walk in the park. You've got to agree that you're within the particular area, and each council has got its nominated areas. You got to liaise with the person in charge of that, get the whole thing agreed, do the business, and you get that relief, which is very, very valuable. Now, there are two sorts on that, right? One is for commercial, and the other is for residential.
Okay.
So it's worthwhile investigating those.
Living City Initiative.
Living City Initiative.
Interesting. I hadn't come across that one. Okay.
Yeah. Okay.
In terms of, so you help people do tax returns. I'm sure listeners who maybe they're already landlords or maybe they're considering it.
Yeah.
After your capital allowances, and typically, right? So I'm going to ask you for a typical, right? Single, 3-bed semi that's rented out in, some suburb. Um, so you have your gross income, gross rental income, and then you have, you've everything then that has to be paid, right? You've expenses,
Yeah. Yeah.
property taxes and all the rest of it.
Yeah.
Capital allowances, repairs, typically. Is it fair to say, realistically, you know, net tax rate that people would pay on that income is certain?
Yeah. Well, yeah.
Or
See,
is it too
yeah.
broad a question?
Yeah. Well, no, it's a good question and one that occurs often. And when you hear people saying, "Oh, the tax system is ridiculous in Ireland," yes, there are many issues around it. But if you could think of your total income like a tree, okay? John Lowe, the financial doctor there, he uses this analogy, and I like it. So you've got income coming in from your PAYE job, your shares, or whatever else you may have, and your rental income, and it all comes into the basic trunk, if you like, and that's when the tax rate is applied. So what you got to watch is
Totally.
what that is. So if you're at 40%, any additional income, be it from investments, be it from being self-employed and a PAYE job, you're going to be hit right at your highest rate of tax.
Yeah.
So there's no unique tax rate that applies to landlords. It's just the overall income that decides the tax rates. Bear in mind, look, our basic tax credits, if you have a joint income, it's up at 84,000 at 20%. It's reasonable enough. But bear in mind, when you get your certificate of tax credits, the way the revenue do it, to try and equalize the amount they do give you over the year, it looks as if you're not getting your 20%, but it is confusing and complex in its own particular way. So there's no absolute tax credit for that, or there's no tax credit for dividend income either. And what? Actually, it just did a case there recently where this post-company surcharge that I mentioned to you earlier on.
Yeah.
And when we declared the dividends, when we crunched our numbers, we found it was actually cheaper from a tax point of view to pay the closed company surcharge because of the way the person's tax allowance worked out. So again, each case is different. So you need to watch that carefully, what you're doing.
And that, I guess, ties in with my thinking around that. And probably the question I should have asked around, is there a tax rate or a range that you could see? I think maybe a better way of asking that or thinking about this would be of the rental income that's coming in, right? This is maybe the way, and maybe it's not, right? But of the let's say it's €100 a month rental income is what is paid by the tenant to you. Typically, what percentage of that income will be taxed?
Right. It depends on the, I'm sorry.
Oh, of course it does. Of course it does.
It depends on the interest rate that you're paying and what interest you can deduct. What I would suggest to listeners, if they go on to the Landlord Tax Returns website, or I can send it to yourself, I've got a spreadsheet where I'll call it a stress calculator. Yes. And the idea about that is you put in your numbers, you put in whatever interest rate you're paying and the other expenses.
Yeah.
And it'll calculate for you what your tax is due.
Okay.
Right? Now, there's two flavors to it in the one spreadsheet, two separate tabs, one for a limited company and one for a sole trade. Okay. Just one tip that I would give, though, is if you're operating in your own name, you're better off having it if you're in a relationship, let's say it's either a civil partnership or a marriage, hold it in both names. The property, yeah, for a number of reasons. But also, if you got joint incomes, you get the higher tax band relief. Yeah. So that's worthwhile looking at that, because it does make it more attractive. And if one person gets the call to God or to their God, it just flows directly into this remaining partner.
Joint names for
Joint names, yeah.
Services on a lot of things is the way to go.
Yeah, absolutely, yeah.
And speaking of being called to God, things change, right? So our incomes will change. So I think this is an interesting one, and this applies to pensions, and as it does with any other form of asset that's generating or will generate income. So
Yeah.
if you're in a PAYE role now and you're earning $100,000 and you've got rental income coming in on top of it, you're going to be paying high rates of tax on that rental income. But when you leave that, or if you reduce hours, or if you change role to lower salaries, then those things will change. Or if you retire entirely and your only source of income is the rental income, right, then that could be very, very tax advantageous and pay very little tax on it. Likewise, you can turn on pensions or segments of pensions to suit and to maximize those bands. Is that a fair observation as well, Brandon?
Yeah, I would agree with you. Look, I hear from time to time negative talk about pensions, but what you've got to understand, if you're a taxpayer, it is the greatest saving scheme that you're going to have in your whole life, because you're getting tax relief at whatever marginal rate you're at, depending on the scheme. And then you've got the benefit of that when, you're at retirement age, typically 60 plus or something like that. So it's worthwhile looking seriously. And the earlier you join, the cheaper it is. I mean, why not do it when you're getting tax relief? Because look, we're all, hopefully, if we live long enough, going to end up retired or, meeting our God. But you've got to make sure you've got sufficient provision, when you get to retirement age. I mean, I'm sure you give your clients, look, what do you want to retire on, €1 million or 50 euros, and what do you need to contribute? Your age factor is key. Get in early and you'll be astonished how the contributions build up. And as we talked about earlier about Goldilocks, when you've got sufficient inside in your pension scheme, subject to trustees and all the other magic that's involved with pensions, you can have a property in your pension scheme. And that's really worthwhile, I personally believe, to understand, like from a government perspective, they want you to contribute to your pension scheme. We've now got to have auto enrollment, as you're probably familiar with. But the reason why they're doing that is to avoid the reliance on the state pension. Because ultimately, in the long term blue sky thinking is the government, not just in Ireland, but UK and other countries, are looking at a situation where people can self-fund pensions, not rely on the state pension.
Yeah.
And if you think of it long term, that has got to make sense. Ignoring a pension, if you're a young person starting out in your life, you are being very foolish.
And do you know what? You're absolutely spot on. I think it's very difficult to wean people off the idea of the state pension being there, particularly when they increase it constantly, right?
Yeah.
It is extremely generous. If you were to try and buy that defined benefit pension that the state pension is,
couldn't do it. Yeah.
Cost you, I think, it's 600,000 or so. The last numbers I was looking at, right? It's extremely generous. So it is a difficult one to square and to wean us off that. Okay.
And sorry, by the way, you must remember that your state pension is not taxed at source. It is taxable income. So if you're in receipt of a state pension, there is tax on it. And I guess very difficult. A few years ago, the revenue scared the daylights out of the retired community by telling them you must pay tax on your pension. But anyway, it's died down, but it's still an obligation.
Yeah, absolutely. Yeah, in conjunction with your other incomes, absolutely.
Yeah.
Okay, in terms of conscious of time now, we've gone way over time here, Brennan. Thank
Well,
you.
we're talking about tax, so
There you go. Says you love
but
it. You
yeah,
love it.
I love it. Yeah.
Right. And as do I, to be honest. Sometimes I think, should I have studied tax? But anyway,
Oh,
maybe,
you went for
maybe
the
we
big
will.
money.
Maybe we will. The exit tax, again, it's another topic that's been hitting the papers. This potential leveling of exit tax on investments, from the 41% to equalize it in some way to capital
Yeah.
gains tax, which is 33. And me being a cynic, I said they'll equalize it by increasing by increasing both to 41. But anyway,
Yeah.
I'm looking at this.
Well, there is the potential for doing that because in some countries, capital gains tax is much higher,
Mm,
3%. In
mm,
the UK, in certain circumstances, you can get up to 40%, and in other countries it's worthwhile just observing what's going on there. Because bear in mind, the government here they look at the UK particularly, what's happening there, because in many ways our cultures and our approach is somewhat the same. So if they've got a 40% rate, we have a 33% rate, what would you do if you were the Taoiseach or the Minister for Finance? So we've got to think long term and position ourselves whereby we can reduce our tax liability. I'm not saying negate it, because part of the joy and the price of living in Ireland is you pay tax. And I get irritated sometimes with some people say, I don't want to pay any tax at all. Well, then don't drive on the roads. Don't go to the local shop or whatever. But you've got to realize your taxes, yes, some of them are wasted, right? Yeah. But not all of them. No. Not all of them. For example, we've got a daughter who lives in Stockholm, and the Swedish system, and by the way, if you want to find out somebody's income in Sweden or some of the Nordic countries, it's very easy because everybody's income is disclosed.
Yeah.
But people don't mind paying up to 70% tax there.
Because they're getting value.
They're getting value. They're getting a perceived value. And our problem here, I think, in Ireland is, while we've got, our top rate effectively is 52%, but there's no perception of real value.
Yes.
People don't trust our politicians in the way that other countries do. Now, it's changing slowly with, say, free child health care and
yes.
Health cards for older folks and all various other things like that for myself. So again, the tax system is something that it changes regularly, but if you look at the direction of change, where they're trying to take us, what should you do as an individual starting out in your career? Auto enrollment. Should you have your own pension scheme? Yeah. Where should you position yourself in 10 years' time? If you think of the old rocking chair test, right, where you're in your late 70s, you're sitting on your rocking chair, you've got your glass of Chardonnay, and you look back at when you were in your early 30s and say, gosh, I wish I'd taken out a pension. Do you know what I mean? So you've got to think long term and don't ignore the future. Living just for now is not a good way. So I always ask clients about the rocking chair test because I think it focuses people's minds on where they're going and what do they want to do,
I'm sure most people would say, I won't be in a rocking chair at late 70s, maybe early 90s, Brendan, but I won't be in it at late 70s.
That's all the more reason for getting your pension right. I mean, if you think of what they're doing with the state pension now, right, when do you qualify for it? It's much later, and they'll keep shoving that out, Yeah. So all the more reason to have your own pension, your own personal savings scheme. Think of it. You're paying less tax, But look, that's my own little personal hobby horse thing. There's one other phenomenon that I would just like to talk to you about. If that is changing the Irish housing market.
All right.
And it's a number of aspects to it, is the Airbnb situation.
Okay, yeah.
Countries across Europe and across the world are not happy with Airbnb. And what they see is this, Airbnbs are taking property out of long-term rental situations. And bear in mind, if you are in an Airbnb property owner, you have got tax obligations. And once your income goes over the VAT threshold, guess what? You've VAT to be considered as well. Yeah. So, and the government will eventually bring in registration. They've been talking about this for a few years with Board Fáilte to make sure you comply. So they're going to make it more difficult. Yeah. And the other phenomenon that's happening is called HMOs, houses of multiple occupancy.
Okay.
And yes. What I found is that there are a large number of landlords going in that direction for a number of reasons. Number one, typically HMOs are outside the scope of the RTB. Mm-hmm. And what that means is you don't have this registration requirement, but also you can recover your property much more quickly because we're on a license agreement. Okay. So the key is not to give exclusive possession of your property. And that would, you give a license to the property to habit one room. And in that room, in that license agreement, you have what's called a mobility clause if it's drawn up property. So you can move Brendan Allen from room 1 to room 5, okay, at my discretion as the owner of the property.
That's practically for a HMO.
For a HMO. But the problem then is this. If you're providing other services in a HMO environment, VAT will occur as well. So it's something to bear in mind.
Other services?
Sorry? Yeah, what I mean by that is typically in your HMO, you as the owner of the property would be paying the electricity bill, paying the internet bill. You would have a cleaning service, either yourself doing it or sending somebody in to clean it, and where you're providing almost hotel-style accommodation. So again, VAT comes in. But there was an interesting ruling, by the way, in the appeal commissioners. And the appeal commissioners looked at a similar situation to this and decided if you're in this space, you're actually trading. Now, think about that. So for trading, guess what? If you're inside in a limited company, what tax rate do you pay? 12.5%.
Okay, yeah.
Which is quite nice.
Yeah.
But also, if you're trading, are you entitled to entrepreneurial relief and retirement relief?
Nice exit potentially, yeah.
Exactly. So I see that now with more clients are moving into that space. Now you've got to do it per
demand for HMO, is that being driven by particular cohort of people or students?
What it is.
Or what is it?
Well, students are a separate area which are slightly separate, and that doesn't apply to their students. Now, so typically, if you think about the number of factories that are being built, the data centers that are built, or in my local area here, we're going to be having the solar farms coming on stream.
Carlow, of course. Right?
Tullow, County Carlow, the heart of Ireland.
Sean O'Brien. It's only famous for Sean O'Brien. Apart from that,
Jesus, get out of that. What about Christy O'Connor?
Oh, was he there as well? Right?
Yeah, well, he was something. He got his call to God.
Yes.
But anyway, the issue is the workmen will want accommodation.
Yes.
For the period of construction.
Yeah.
So it might be 6 months, it might be 2 years, whatever. So you get a lot of people in that area, or you get, for example, doctors who might be contracted to a hospital in Cork, but are actually on the staff of one of the Dublin hospitals. And there's lots of variants of that that apply as well. So, but it is a trend I'm seeing. To be honest with you.
Okay. Brendan, conscious that I need to wrap up now shortly. So,
Look, we're having so much fun.
I know we could, in fairness, we could chat away about all the different nuances and aspects, right? Maybe we'll have to do a version 2 later in the year. I ask every guest for, or most guests when I remember it, for a book recommendation. So maybe it's a book that stood out for you, or that you go back to, or that you really enjoyed, fact or fiction.
Yeah. Well, there are a number of books, and my factual books would be the Finance Act 25. But the book that I like to read from time to time is The Affair at Styles by Agatha Christie. It's just the affair, as in affair, at Styles. It's just an interesting little conundrum that is worth reading, as opposed to watching on TV, because it's different there. And the other one, another book that I like to read is The World According to Garp, which I've read about 4 or 5 times now. It's very old.
I don't think I've read it. Yeah.
Yeah, but it's worthwhile. And I can't remember the author's name, but it was made into a film with Robbie Williams, the comedian who died.
Oh, Robin Williams. Yeah, okay.
But again, it's a lovely book to read, and it's intriguing, with how he's born. Oh, I won't go into that. It's not appropriate for a podcast.
People have to read it or watch the movie, perhaps.
Or watch the movie, exactly.
Okay. Brendan, thank you very much indeed for coming on. You obviously have a deep interest and experience with all of this, and it's really nice to hear you talk freely about all the different aspects. So the landlordtaxreturns.ie, is that the best place if people
Yeah, Sinead Gadira, okay, that's exactly it. And you're welcome. As I said, there's a free download there, the stress test calculator.
Yeah, brilliant.
If you're looking at getting into the property market. But there are a few things we haven't touched on, but look, maybe a part 2 later in the year.
Part Iverado. Right. Brendan, good.
Okay.
Thank you very much, sir.
Good night, Bear Thank you. Slán then. Bye. Bye. Oops.